Hello and welcome to your journey of finessing the markets of Forex. I want you guys to keep an open mind. I want to thank you for taking your first step forward in this journey. And don't overcomplicate anything. Ask as many questions as you want in the chat. And if you keep it simple, it will remain simple. If you complicate it, it will just get more complicated. So let's get into it. Currency pairs. This is what is traded in the financial markets. This is what is traded in Forex. So the symbol that you would see in your app when you're trading is this: GBP USD, EUR USD, etc., etc. You are not physically buying these pairs. Like, you're not taking Great Britain pound and buying it and selling it into United States dollar physically. You are taking a pair, and based on the first pair, which would be right down here, straight down, the primary, and the second pair, the quote, you're taking this and relating it to that. Simply, you would just type this in, see what the chart is doing, and move on from there. So for right now, feel free to take a picture of this. Don't worry about the slang. This is all slang. So the GBP is called cable. The EUR USD is called euro. You could just simplify it and call it GU, EU, UJ, U chef, U CAD. You don't have to overcomplicate it. So you could just take a picture, write these down. This is exactly what it is written out. So Great Britain pound, British pound, United States dollar, euro dollar, dollar, Japanese yen, etc., etc. So this is what is traded in the financial markets of Forex. Okay. Now these are the sessions that the market is open. So you have the market open from Monday to Friday, from 5 p.m. on Sunday all the way to Friday at 5 p.m. Okay? This means that it fits into whatever schedule that you have. You can trade anytime, 24 hours a day, from Monday to Friday. You couldn't work weekends even if you wanted to. Trading. What you could do is go back and study your methods and study Forex so you can come back Monday with a fresh mind into analyzing the market and making some cash. So you have the Sydney market, the Tokyo market, the London market, and the New York market. Everything here is in Eastern Standard Time because we are based over here in the United States. So Sydney market is open from 5 p.m. to 2 a.m. That means all the Aussie pairs, the Australian dollars, because that's in Sydney, would be operating and have more volatility, meaning they'll have more strength to move during its time. So you connect the dots. Tokyo, the market is open from 7 p.m. to 4 a.m. So you would go and say, okay, the Japanese yen, which is based in Tokyo, right? That would be moving between the hours of 7 and 4 a.m. But wait, what about the United States dollar? Okay, so we have the New York session. So you know if this is open from 7 p.m. to 4 a.m. and this is open from 8 a.m. to 5 p.m., there's an underlying factor between the hours of 5 p.m. to 7 p.m. So I wouldn't be a trade or entering a trade in between those times. But going into the night, which would be here, 7 p.m. to 4 a.m., you can find your entry. And then you can go into the New York session and see how the pair moves with the United States dollar. That's how that works. So if you have the Japanese dollar, right? The Japanese yen, right? It would be moving between the hours of 7 p.m. to 4 a.m. And then the United States part of it would weigh in at the New York session. That's a way to gauge it out. Now, would you enter in on anything between, like, let's just say the EUR chef during the New York session? No, you wouldn't see as much volatility, right? That's all that means. You just connect the dots. If Tokyo goes with Japanese yen, London goes with Great Britain pound, New York goes with the United States dollar, et cetera, et cetera. That's all you have to take from that. But the market is open 24 hours a day, 5 days a week. You can enter in on any one of these pairs during any amount of these times. See how that fits into your schedule. Now, why Forex? Just because of these trading sessions. You want to break the clock. You want to get out of the rat race. Like, for instance, let's say you have your 9-to-5s and you have your kids and you have your relationship and you have your family. We all know all these things can get jumbled up, right? And you get put into a routine, and then you start doubting yourself and saying, I don't have enough time for this, that, and that. So the reason why we love Forex is because we're able to access it anywhere, remotely. And having the freedom to work remotely gives you the opportunity to take on other things that you want to do with your time. For instance, let's just say you have your kids and you want to go spend some time with your kids. Now you'll be able to, because while they're having fun, you'll be able to go work and then close it up and go be able to have fun with them. Anything along those lines. This is exactly what we want. I can't explain it any more simple. It's just breaking the clock and having that freedom. But we're still working. Don't think that this is just a get rich quick scheme. You have to do the work. And the work is analyzing the markets. Now, does this look like another language right now? Yeah, and it did the same thing to us. When we started, we had no idea what we were looking at, but with time, as with anything, if you're learning something new, you will be able to come to understand what you're looking at. It just takes time. Once you have a concept of time and patience, discipline and consistency, you'll be able to understand this. Don't overthink it. Just take your time. Is there a risk in Forex? Yes, there is a risk in Forex. However, you control 100% of that risk. So let's say you have a set amount of money in your trading account, right? You control that trading account. You control how much you want to trade, how much you want to lose, how much you want to gain. So if you have control over everything, how is it a quote unquote scam? How is it a get rich quick scheme if you control everything? And we will explain that to you. You don't have to worry about, am I going to lose money? Yes, but the game about this, it's an adult's video game. The goal is to get a high score. Are you going to lose trades? Yes, that is inevitable. But if you can control your risk management, then if you have more wins than losses, then you will ultimately be profitable. You just have to know when to trade. When the market is not giving you what you want, then you stay away from it. That's the discipline you have to understand. The market is 10% buy, 10% sell. There's only two buttons, but it's 80% psychology. You have to be able to understand that the market is not good today. I shouldn't trade today. This is not the setup I was looking for. You don't wake up with this and say, you know what, I need to make some money today. No, it doesn't work that way. You have to be able to understand that the market will set up when it is ready, and you just have to be there when it is ready. Now, is there a way to set up things to make this work for you? For instance, how do I know when it's going to be set up for me? You can set an alert that will go to your phone, that will send you an email, that will send you a notification. There are ways to work this around into your schedule to make it as simple as possible, but you still have to do your work, which is the screen time. You have to spend the time on the charts, and we'll get into that. Nothing crazy as yet. If you can save money, if you have a savings account, you can trade. Because if you're able to save money and still maintain your bills and maintain everything that you want and need and still having savings account, then you can trade. Why? Because that is your risk management right there. I need and want these things. I have to pay my bills, and I'm still able to put money away. And if your savings constantly goes up, then you can trade. Because if you're able to save and that money goes up and you're still able to pay your bills, then this is another income for you. And that's ultimately what the savings is for. You want to save for a hard day. This is a way to capitalize and grow your quote unquote savings, and still in the long term, but at the same time, you're in control of your APY. You're in control of your interest rate. Now, how much can you make with Forex? We have a video for this. I will put a link to it for you guys to go watch on YouTube about how much you can make with Forex. But for now, again, you can also take a picture of this and save it, write it down in your notebooks. That is exactly what we did when we started. So don't worry about nano lot. This has nothing to do with anything. We trade from this and up. So these are the lot sizes. Now, lot sizes transforms into, these are the units. We don't really need that. We just need the lot size into the volume. So the lot size, a micro lot, is 0.01. Pips is the points that we want. Okay? Pip stands for point in percentage. It's just points, just to keep it simple. So we want to get a high score. So how do you get a high score? By getting the most points, right? So when you're trading, you control the size of money that you want to make and risk. So you can make 1 pip equal to 10 cents trading at this size. You can make 1 pip equal $1 per point trading at this size. Or you can make $1. You can make 1 pip count as $10 trading at this size, and it goes above and beyond. You can trade it as high as you like and as low as you like. It's to 0.01, but it's all under risk management. Now, let's say you have $100, right, and you want to go trade at a 1.00. That means you only have 10 points before you blow your whole $100. That is not wise. That is not how it works. What you would have to do is sit back, because it's $100, and you can trade anywhere around here, right? So once you do that, then you're able to understand the risk management level. And don't worry, you will get to these sides and up. It just takes time. So again, I'll put the link to the video about how much you can make with Forex, and you'll be able to go into that. Now, what is the finesse? The finesse is that we keep the market simple. We follow the direction of trend, which is fundamentals, and we enter with technical. So fundamentals is the news of the market. That's what moves the market, news. And technical is seeing a pattern within the market to be able to verify our entry to get into the market. So we enter, right? You can write this down as well. We enter with technical and we follow fundamentals. To simplify that, we enter with a pattern and we follow the direction. Now you will come to understand what that means. Why trade with us? We like to explain everything as simple as possible. We don't like to complicate definitions because everything about this industry has so many different words, but they all mean the same thing. Here's some testimonials that we wanted to show you guys. We just wanted you guys to be comfortable and to just really sit back, relax, and just dive into the information. Take the time to study this information and apply it at your own pace. It does take time, but you will be able to succeed. Now let's get into it. Let me get down to the nitty gritty. Now, after you understand trading sessions and the time zones and what Forex is, to gain access to these markets, you need a broker. Now, for instance, let's say you go to a club. Before you go into the club, you have to get your license or your ID verified, and you might have to pay a cover charge. That's to go into the club, right? That's what the broker does for you. It pretty much grants you access to go trade in the financial markets. And at the end of the year, when you're filing your taxes, they will give you your statement to go file your taxes. So what is a Forex broker? Forex brokers are firms that provide traders with access to a platform that allows them to buy and sell foreign currencies. Like I said, there's two options, buy and sell. Transactions in this market are always between a pair of two different currencies. So Forex traders either buy or sell the particular pair they want to trade. So we only have two options, but with a broker, you want to make sure that it is regulated. Why you want to make sure that it is regulated is because if that broker goes to shit, like if it goes to hell and they don't work out and the company gets bankrupt, your money is protected. If it is not regulated, they are free to operate any way they want. And if that company goes to shit, you could lose your money. Now, most brokers are not operating within the United States. So since they're not operating in the United States, do keep in mind that you should make sure that they are regulated. We will have two brokers that we actually have used before, and they are regulated. And well, yeah, these are brokers that we have used before, and you're free to check into them if you'd like. One would be Trader's Way, where I believe the minimum deposit is $10, and the other one is Hugo's Way. Okay. Now, both of them, you're able to open a demo account. You are able to have it on your phone through MetaTrader 5, MetaTrader 4, etc., and you can access all the markets within them. Now, from here, we're going to go into the dynamics of trading now, okay? In your email, you guys got the Candlestick Bible, correct? So remember I was talking about technicals and fundamentals? Technicals would be patterns. One of the patterns I like is the engulfing bar. You can find this in the Candlestick Bible in your emails. I also have a video on YouTube that goes over certain things I like within this book. So please check that out so you can concise the whole entire book rather than going through the whole entire thing and confusing yourself about things that you don't really want to see or want to hear. Another thing is, like I said about the names, there's a lot of different names, but they all mean the same shit. So the bearish engulfing bar, some people have an engulfing candle, mother bear candle, something like that. Like, look, they all mean the same thing. Just take the little bit around here and you'll be fine. So a bearish engulfing candle. This is how a bearish engulfing bar pattern looks like on your charts. The candlestick pattern gives us valuable information about bulls and bears in the market, blah, blah, blah. What it really means is if a bear takes, if you have this candlestick pattern and a direction on the higher time frame that we're looking at is taking us to the bearish direction, which would be them. If we see more black candles, that means this is a good confirmation. And if we're looking in the higher time frames, when I say higher time frames, I mean if we're looking more into the future, that this is going to continue selling, because bears mean sell, bulls mean buy. Bears mean it's going to go down, bulls mean it's going to go up. Write that down. So if we can see that the market is going to continuously go down, then the bearish engulfing bar would give us a confirmation that it's going to go down. That's what that means. Another one, I'll give you guys another one. Let's type in Doji. Okay, then we're just going to hit next until we find a Doji. Look how quick that was. There we go. So the Doji candlestick, it's just a neutral candle. Like, it doesn't have a big of a body. The wick is all the same size. It's just a little T. And what this means is pretty much that the bulls came in, they became neutral. The sellers weren't able to take over the market completely as well. So what happened was we came up, they got stopped, they got halted, and now the bears are coming in. And vice versa for the other direction. So if this was down here going up, we can see that the bears would be canceling out. They lost all their strength, and now the bulls are coming in. So pay attention to those two. You have a doji and you have the engulfing candle. All right. So we went over what is Forex. We went over the trading sessions. We went over the pips. We went over how much you can make. We went over the brokers. We went over the candlestick patterns. These are just two out of so many of them. These are just two that we actually like to look at. I'm going to go into TradingView now, which is what we use to look at the charts. Okay. So here we have TradingView. This is what happened. This is what comes up when you type in tradingview.com. You're going to go into the search bar, and I'm going to type in GBPUSD, which is one of the pairs that we saw in our presentation, right? You're going to hit enter, and then you'll get presented with this, which is the Forex chart. It'll tell you British pound, US dollar. You're going to go to full featured chart. Okay. Now, as that loads up, you're going to see everything come in front of you now. Welcome to the financial markets, everybody. These are all your tools. These are your time frames. These are your candles. You can zoom in, scale up and down. All right, go play around with it. Don't be overwhelmed. Okay, welcome to the candlesticks. The red ones are the bears. The green ones are the bulls. The red means it's going down. The green ones means it's going up. All right. I'm going to start off on M, which stands for the monthly time frame. This is the highest time frame that we use. This would give you a breakdown. So every candle here means 1 month. And that means the same thing for all the time frames. So if I went down to the W, which would show me 1 week, every candle there would be 1 week. So if we're doing this, we're on the monthly, every candle here is 1 month, right? So to give you guys an overall understanding, let's just say that the market is low, right? We can see that it's low, big red, and now it's staying down here. So we would say that, okay, the market could potentially go up. If it is going to go up on a higher time frame, then on the lower time frames, we want to get an entry so we can hold it from the lower time frames into the higher time frames. So put it this way. If you have 1 month and you entered on the 1 hour, holding the 1 hour on a monthly time frame, that's a long time for you to be in the right direction to enter from here to go up here. Now, the ruler will show you pips. So if we got in over here, that number right there that says 3373.1, that is 3,373 pips. Take that number, go times it by that chart I showed you with the 0.100 and all that, and you can get a nice number of what can be made. That's how this works. I highly advise that you watch this video over and over so you can get a glimpse of what the market is like, and feel free to always ask us as many questions as you want. Now, let's go into marking up. I'm going to go into how to mark up a chart and I want you guys to write these down. So the first one will be support and resistance. Support is the floor and resistance is the roof. This is called marking up zones. So Forex in a chart is all about taking the big picture and chopping it up so you can get a better vision of the smaller version of it. Because once you understand that you see the whole big picture and then you go down to concising it to a smaller piece of it, then you can see like, okay, if this is the small version of it, then I can see what is going to happen in the big picture. And that is what we call probability, risk management, et cetera, because we want to see what's going to happen on the smaller time frames that will give us a bigger time frame reward, right? So small risk to big reward. That's the name of the game. So I have highlighted the tools that I like to use. You can do the same thing just by coming over here. So for instance, this one is called a trend line. You would just come right over here underneath, hit the arrow, says trend line, and you hit these stars to figure out which ones you guys like to use. So I would highlight horizontal line, trend line, vertical line. We don't need arrows. That's it, just three. A vertical line, a horizontal line, and a trend line. We'll keep it simple. So we're going to start with, let's go with a horizontal line. Let's go across. So how do you mark a zone? Marking a zone is seeing where the market touched the most. So here, we'll put one. Why? Do-do-do-do-do. Do-do-do. Do-do. Do-do. Okay? So like I said, support is the floor. Now we need to go find our roof. So let's go find our roof. Come over here. We can say this is a roof. Why? Because do-do-do. Do-do. Do-do. Bow. Right here. See? Now, this will become our key zone on the monthly time frame. That's it. This became our zone. Why? Because the market came here and turned around, and the market came here and turned around. Simple. Now, this would be our support. This would be our resistance. In the middle of your zone is called your mid-range zone. Find where it touched the most in here. So you want to catch all these wicks. Look at all those wicks. Okay, you zoom in. I'm going to move it up. Why we put it in there? Because that's the middle of my mid-range. That's the middle of my zone, my support, my resistance. Plus, you can right-click these things, guys, and change the colors, whatever you want to do. Like you go right here, a little thing will pop up, whatever color you want. That way, as you do this, as you go down the time frames, you'll be able to differentiate which one is from which time frame. I'm not going to go into all the time frames. I'm just giving you a synopsis of how you mark up zones. So we have our support, our floor, our resistance, our roof, and our mid-range zone. Okay? Now, candlesticks. I'm going right back into that. You're seeing how the market is playing within these zones. After you chop it up, look how nicely it looks now. Now, I'm not saying that these lines that you put is where you should enter a trade. No. All I'm saying is look how the market bounces off these areas. That's all we're looking at. Okay? You'll get into entering trades and everything, but for right now, we're just looking at zones. So we have our zones marked up. We can see more clean what is going on. So we have GBP USD on the monthly time frame. We have our candlesticks right here. You see how some of them are full, nice colors, and then you have like a string like this. That's called a wick. All right, all these little things over here, they're called wicks. When the body doesn't close as a whole, see, this would be a whole candle. I'll zoom in more so you have a better idea of what I'm talking about. Okay. So yeah, this would be a whole candle. Why? Because look, that's a whole body. That means this candle during this month came all the way down here, looked like this, but before, actually, sorry, when the month ended, when March finished, when that month was ending, the last day, the market came all the way back up. Not on that day. It moved throughout the whole month. But when the month was over, it closed right here. That means on March 31st, it closed right up here. Right? So what that means is that the bears, the red guys, they weren't strong enough to stay down here. And then again, the next month, they weren't that strong. And they weren't that strong again. And now the bulls came in. That means the bears lost the war. They weren't strong enough, so the bulls came in. That's what that means. So keep in mind that on every time frame that you go on, Every candle is going to mean something, okay? Now let's go back to some tools so I can give you guys something to highlight. So we have our horizontal lines. Now we're going to go to our vertical lines, right? So a vertical line just helps you keep place of where you're looking at. So let's say we were here. You have a blue line going across, and if I drop it down to a lower time frame, like the weekly time frame, I don't have to scatter around and say, oh shit, what was I looking at? Where was I? Oh, it's right here. See that? Same thing, same zones are still there. We still have candlesticks. But now those 1 month candles are now weekly candles. So every candle here is a week. Okay? So those 1 month has how many weeks? 4 weeks. So those 1 month candles are now cut into 4 week candles. So we have 4 candles now. More candles, more data for us to analyze, and more of us to be able to understand, okay, what's happening on a shorter time frame. So that goes down all the way to the daily. I'll zoom out so you can see that vertical line. See, this is what happens when you're going through and you're like, okay, where's my spot? There's my spot now. See that? You'll never lose your place. This is what the vertical lines are good for. Then we have our 4-hour time frame. I wouldn't really say you have to go use a 3-hour, 2-hour. Like, you don't really have to, but if you want to, by all means, we're not knocking anybody. What we use is the 5-minute, the 15-minute, 30, 1 hour, 4-hour, daily, weekly, monthly. That's the ones that we use. Okay? Because you get a general synopsis of what's going on with those time frames. 2 hours, 3 hours, 1 minute. You don't really need to, but if you find a way, if you somehow develop a way to use those, hey, by all means, we're open to all of it. So let us know. Okay, going back to our zones. So the zones will always remain the same, right? But what happens is you'll never lose your spot if you use these tools. Now, let's go to another one. We have our verticals and we have our horizontals. A trend line. Now, a trend line is when you have multiple touches in a direction. So let's say what we like to do is, this is called a line chart. You have candles and you have a line chart. So I'm going to switch it to a line chart so I have a more clean idea of what's going on, right? Now, let's say, you see how you have this going up? If you take a trend line and you get it from the bottom, and you stretch this line across, you see how it touches there multiple times? This would mean that this is an uptrend. Why? Is because up, down, up, down, up, down, up, stop, right? That means that the market is making higher highs and lower highs, okay? That means that the market is just going up. It's trending up, and the trend is your friend. So if we know that the market is going up, we're going to be looking for buys because you can see that the market is going up. So let's say it's here and it bounced over here. Okay, that means it has to keep going up. That gives me a confirmation for a buy. One confirmation. The more confirmations, the better. Okay, now let's look for a downtrend. Take the same one, start from a point, and bring it down. Right? We have that. If you have to force it, that means it's not good. So let's see. Let's say we didn't have any of that data over there. Let's say down here. Nah, I don't like that. I don't like that either. We'll go find another one. See, it looks like I'm forcing it. So I'll zoom out. Let me zoom out some more. And let's try on top here, right by our vertical line, and see how that works. All right, you bring it across, and then you bring it down. Let's see that. Okay, I like that. Touch, 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 broke out of it, came back down, breakout, retest to it. So what a breakout means, that it came down to it, ultimately sold, came up, came back to touch it. So that means the buyers are in now. Great. Do we get in? No, we want it to come back down. What goes up must come down, not all the way down. What goes down must come up. Okay. So it went up, came back down, gave us our entry because that's a better risk to reward. We're risking less to gain more. And it was out of here. You'll come to understand that. Don't worry about it. So right now we've covered key zones, support and resistance. Support is the floor. Resistance is the roof. We have our mid-range zone in pink. We have trend lines. You have the vertical line to make sure you keep your place on the market. So when you're going through time frames, you don't get confused. All right. Now, Let's get rid of all of that. And let's talk about some patterns. Okay? We're just gonna get rid of everything here. So let's go see if we can find, I'm gonna teach you guys like Dora right now. Let's see if we can find a doji and an engulfing candle. See what we're looking at. So you know what? I'll take it to 15-minute. See, that doesn't look great at all. We want to scale that up. So let's do this. Bring this over here. Do that. Bring this over here. Zoom in. Zoom in. Can we see them yet? No, because we want to keep zooming in. Okay. There we go. We have one right here. Doesn't that look like the picture we were looking at? Let's go back. Let's go back to the Candlestick Bible and see what we're talking about. All right. Let's go over here. Just type that in. Engulf. Okay. Let's go find the one that we want. And look at that. See this? Bearish engulfing candle. Look at that. Bearish engulfing candle. I'll highlight it for you. This is called an eclipse. You just drag, drop, boom. Now you have a nice little circle around the area, and every time frame you go on, that circle will be there. See how that works out? All these tools are just so helpful. So we'll go back over here and see. Remember, okay, now keep an eye on this. Keep an eye on that. And sorry guys, give me 1 second. There we go. Look at that. Likewise. See? Okay. Now that we have that, let's go find another one. Let's go find us a doji. So now, see if we can find us a doji. Doji, 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 doji. Doji, 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 doji. This can almost be one right here. It's a little bit of a body, but almost the same. Okay? I'll go to the Candlestick Bible. We'll go over here. We'll type in doji. And just find it. There you go. See that? So the formation of a doji indicates that buyers are unable to keep price higher and sellers push prices back to the opening price. This is a clear indication that the trend reversal is likely to happen. Okay? So that's what that indicates to us. So once we have a higher time frame direction, then we can go down and look for these candlestick patterns and see, look, the buyers are in, and then now the sellers came in. I hope it's starting to get simple. You can see it. You can see it. I promise you. Just take some time, and you will get there. If you watch this over and over, you will get there. I'll leave you guys with that, with the engulfing candle and the doji candle. Go along with that, and you'll be able to understand more. But always feel free to ask us questions. Bother the shit out of us. We want you guys to, because when we were learning, we weren't able to bother anybody. We want you guys to have that freedom. If you have a question, I don't care what time it is, you guys send that question in, okay? Now, let's go into, I'm going to go into a tool now, okay? See what kind of tools can help you guys out. So we have something called the moving average. And a moving average is, you guys, I'm pretty sure everyone knows what an average is, and it's just the middle of what is going on. So if you have, like, you know, the average of, no, I'm not going to complicate it. It's just the average of what is the market doing. So it's a moving average. So it gives you the overall, movement of the market. So let's just say, okay, it's going down, right? So it's going to tell you the average place it comes back to is right here. The average place when it goes up, the average place it goes up to is right here. It's for you to get in. Now, we do not rely on tools or indicators. We rely on our minds and our eyes. Tools just assist us. They don't do the work for us. All these things are tools. You have to do your work yourself. So we saw that the market, we had a doji over here and the market was coming down, right? We had our bearish engulfing candle and it came down. Great, it's over now. Now it's going up. Okay, if it went up, do we want to get in over here? No, we don't know that it's going up. Now that we see that it went up, it came back down. Remember, what goes up must come down. It came back down and then it went up. That's the precision. That's the finesse. You have to wait. It went up. It came back. When it came back, then we got in. Simple. Okay, this average is called the EMA, which is called the exponential moving average. You could write that down. Exponential moving average. Okay, so look at you guys. You guys have zones, you guys have tools, you guys have indicators, you guys have patterns. You understand that everything is done remotely. That's the freedom of this. You just need an internet connection. Now, what moves the market? News. So I'm going to leave TradingView now and take you guys over to what moves the market. So we're going to open up a new tab, and I'm going to type in forexfactory.com. Write that website down. Here we can see the news of the market. It comes up just like this. And every day it's going to show you what is affecting the market. So tomorrow is Friday, August 14th. At 8:30 in the morning, we have red folders. Yellow folders mean it's not really that volatile. Red folders means it's very volatile. So we're going to see a lot of strength, right? So we can anticipate at 8:30 in the morning, United States pairs are going to be affected. GBP USD, this is a United States secondary pair. It should be affected between the hours of London and New York session. So during New York at 8:30 in the morning, you want to be conscious that at 8:30, okay, I might see some volatility. I might see some strength. I might see some big movements at this time. Do I want to be in or do I want to be out? Or maybe I just want to watch. And always remember that option. Maybe I just want to watch. Because there's nothing wrong with watching the market. If you can see your analysis coming together, let's just say you look at GU and you say, you know what, I think this is going to go up. Okay. And if you watch it and it goes up, take note of that. Write that down. Because if you do, you can keep track of your trades. And once you keep track of your trades, you'll be able to just have a log of how many trades did I win this week, how many trades did I lose this week or month. However you trade, doesn't matter. As long as you log it, you can keep a track of it. If you have a track record of it, then you can weigh out your trades, and then you come to understand, like, okay, this is my risk to win ratio. Like, I lose this much trades to this much trades. I want to be able to make my wins exceed my losses. And then once you do that, you become consistent with that. It's time to fund that real account. That's it, guys. That's how it works. So we have our Discord. You guys feel free to come into our chat, say whatever you want with us, ask us whatever you want. It's completely fine. We encourage you to ask questions. There is no such thing as a dumb question. Everything is liable to be asked. It's completely fine. Don't feel shy. Because when me and Xavier were starting out, we didn't have much people to ask questions to. Our questions didn't get answered, and we were just like lost in the road. We were just going with the wind. So you guys feel free to ask us whatever you want because we want to help you, okay? If you guys ever need a Zoom, let us know. If you need a meeting, like, you know what, I think I need a one-on-one, let us know. There's nothing wrong with that. We encourage it, all right? So until next time, guys, I hope this video helps you out. Take the time to watch it over and over, and I'll see you guys on the next trade. Take care.